This conference will now be recorded.
Hi everyone, it's Patrick Reed from the Advanced Principal. We have Beat in the house. Hello.
Hi Patrick, how are you?
I'm very well. I have to apologise. I've got a cold, and the weather in London is pretty awful, and that's why I sound like this. I haven't been out partying. My days of partying are well over. It's just a common cold, and so if you just put up with it, I really appreciate it. And yeah, so we've got some we've got like four or five topics today, but they're really important topics, and something that I want to kick off with is quite interesting, and I just want to it's basically a chart that was bandied around, and I caught hold of it. I think yourself sent it to me, B, or someone, and it was the Eurodollars futures yields chart. And basically, the long and short of it was pricing in a rate cut in 2020. That's the long and short of it. Now, this is really interesting. Lots of stuff to talk about. We'll talk about December, which is pretty much a slam dunk. Not sure it's going to be 25 basis points, but this is the first time I've seen a chart like this. Now, in my experience, excuse me, in my experience, I tend to look for the OIS when I want a good indication on the rate path. There is another chart you can look at, which is the Eurodollar futures, the offshore dollars yields in time frames. I know in my experience around GFC, it was pointing to a more realistic and bleak picture than the OIS. This is important to put into context of what we're talking about right now. So 2020, a rate cut. What are you going to do about that, Beat? How do you trade it?
To be honest, I think it's not the first time that I think I heard about it early last week already that 2019 is now down to 10 basis points, while the Fed is probably still at 3 hikes or 2.5 or whatever. And it was indicated that we actually could go into a recession in 2020, which is probably where the rate cut comes in on the interest rate product. I don't think that's something to look at right now. What's more important for me is going to be the dollar. We've been a bit critical about the dollar for a while. It just couldn't move because of the Brexit worries. But the dollar will be the one that probably already for 2019 is going to come under pressure. We discussed, I think, yesterday and offline a little bit, the problem, the conundrum of Brexit, or nasty Brexit or disorderly Brexit hurting the euro. That's why we might have to look at other dollars that are less influenced by, the whole Brexit problem. And I know we looked at dollar yen for quite some time, and it's magically still holding in quite well. But that's possibly a dollar that is a sell after I expect, let's put it that first. I expect a dovish hike next week. So I expect 25 basis points hike, but the language going more towards not dovish. I don't think is going to be very dovish. I just think the one thing that the market, in my opinion, hasn't understood yet is the Fed is not going to pre-commit anymore. Yes, we're going to have the dot plot. Maybe it stays. I'm a big believer, and I think one of the Fed speakers mentioned it. We're going to get less forward guidance. We're going to have every meeting is live next year. So Powell has the chance to, address people every single rate meeting, and maybe comment on the data. I really do think the Fed is going to not hike at all if the data turns sour. The Fed is going to hike 3 times if the data reaccelerates. So I think we're all in the same boat, the market as well as the Fed. Maybe the Fed has 1 or 2 advantages or forward-looking indicators, but overall, I think the message is not dovish or hawkish. It's just going to be, okay, we're near the current neutral, which might be another hike now in December, and who knows, one in 2019, which brings us to the right level of interest rates if data remains as it is, as in, flatten out. I mean, all the data we've seen of late is kind of, bumping around. So it's not like no smoking guns in any of the data. And who knows, maybe trade war, global growth that is slowing down is finally leading to softer data, which means that automatically means maybe the market is right in just having 10 basis points for 2019 is kind of half a hike, and we go either to 0 or 1 hike. And maybe that's where the truth is, and that should hurt the dollar. Whether it's going to be a big dollar bear market, I doubt. I have a very cynical view right now about euro dollar, which you don't like to hear. It's going to stay in the range.
Yeah.
112, 117. Why? And then we have to maybe quickly switch back to last week. We had what I consider to be a somewhat dovish ECB, not dovish, but somewhat, with Draghi saying the risks are tilted to the downside. We had horrible PMIs out on Friday, really weak PMIs. So there's no doubt the Bundesbank downgraded 2018 growth from 2% to 1.5%. So that's the Europe, the largest economy. So there's no doubt the ECB might actually be on delay on the first hike next year. So what happens is we look for this divergence to open up again. So Fed less hawkish, ECB starting to normalize policy. And now what happens is European data comes in softer. The ECB normalization is kind of, who knows. And suddenly we're in the same, we don't open that spread. We don't create a divergence between Europe and the US. So that means, only a disorderly Brexit will make the euro break out of this range on the downside, or European data suddenly come back and ECB can finally start to, become a little bit more hawkish again, which then lifts it to the other side, and euro can maybe possibly break out on the top side. As things stand from last week, sorry, but that range is here to stay, sadly. It's horrible to say.
I'm not accepting it.
Yeah, I know. I mean,
I don't want that. So here's the question for you, mate.
Yeah.
All of that is, and that's why we're sticking around. It's directionless euro dollar, and okay. So the dots, I pretty much feel they're going to be revised much lower. If they don't get revised lower, it's going to make the Fed look a bit out of sorts, because the market's saying something very different. And I think from the last point, the last projections, we were still around 3 next year, maybe 4. If the dots do get projected lower, is that a trade?
Yeah, I think so. It's definitely a short-term trade. I would think the euro probably has 100 or 200 points in it on the top side, quick ones.
Okay.
But, and here comes the big but, I don't think you hang on to the position. I would love to be long euro, based around what I believe. But if you just get that car crash in the UK, and there is talk that Theresa May might be forced to bring her deal to a vote next week. So no one can really embrace the euro. Yes, we have a quick trade. And it's definitely the right thing to just buy some euros, see what happens. It's definitely going to bounce. But I think you have to cut it again. We're not yet in a buy and hold situation. Maybe we see a quick 115, 114 and a half, 115. But then people will turn around and go, like, you know what? We still have that Brexit risk. And I don't think anyone wants to buy strength in the euro with the risk of a no-deal Brexit. So that is what really drives me crazy right now, because there are trades out there which I would love to do, that you can't do. Because you know what, if you get a disorderly Brexit, euro is 110 or 108 or 107 or whatever, no matter what the Fed is doing. So, you know, and that's why you probably have to continue to hit and run. There's no buy and hold in the euro next week, even on a dovish Fed.
Okay, so if the Fed hikes 18 basis points next week, that's going to be fun.
No, they're going to hike 25.
Yeah.
Yeah. What I meant with the 18 basis points, that's just what's currently priced. That just tells you they don't hike. Fixed income has to correct 18 basis points, and if they do hike, it has to correct 7.
Yeah.
So it's either 0 or 25. No, they're not gonna. That's just what the market is currently pricing. What is telling you only that we have reduced from 100% probability to, what's that? Probably 7%, 65%, exactly. Right? So that's the only thing that it's telling you.
But if for someone, I don't think I've ever done it in history. I've never heard of it. But if they did do that, that would be a nightmare to trade, wouldn't it?
Oh,
because I think the ECB were looking at 10 basis points on their depot at one point, which was horrible. I think they did that once. Oh, that was horrible.
Once you're so low, you know, then you have a problem, right? You can't do 25 basis points. The Fed now is gonna, to be honest, I would be shocked if they don't hike.
Yeah.
Because they would have had to talk it down a lot more. So pricing in 18 basis points still means it's a hike. Okay.
So if they hike and the dot's lower, then you want to be buying euros.
Yeah. No, you basically have a dovish hike. I expect. So it's basically a hike, and then say, you know what? He's probably not going to tell us it's a pause. That might be a bit too dovish.
Yeah.
But he will find ways to communicate that we will understand that March might be in question. So I personally think March, we're not going to see a hike in March, unless data's just going through the roof, which I don't expect. So,
and also, I mean, I agree. I think also we're getting to a stage where it's that live meeting thing as well. And, you know, just looking at I think it was at the Dallas Fed, I keep coming back to this, I've said it before, in the sense that, you know, they've got their indicators and it's all, you know, but in actual fact, what they see and the changes they put into place doesn't actually affect the real economy for way down the line, you know, because these things are very slow moving. And this is straight from Jay Powell. And he's basically saying if you're in a room full of furniture and you turn the light off, you slow down. You don't start running around and you feel your way out, you know, and that to me is, you know, that's from him, and it kind of makes sense. You know, they don't really have a crystal ball to see the future. You know, they have obviously some fantastic economists. Some may disagree with me, but they do their best. But in actual fact, it is you know, very, very difficult.
Yeah. The other thing which we have talked about in this forum a few times, and maybe now it's the right time to bring it back. 2019 will see a more dovish Fed than 2018 was. We lose Mester, who was a hawk. We lose Barkin, who was a hawk. So we basically rotate 2 hawks out, only one comes in, which is George, which is the biggest hawk on the planet. He's going to be out in 2019. But we have a dovish leaning Fed, if you look at the cheat sheet for 2019 anyway.
Yeah.
So that makes probably JP's job a little bit easier.
Yeah.
In the sense to, if he feels it's time to just, you know, step back a little bit, he's going to have the support from the FOMC, given we have a dovish leaning Fed for 2019. So that probably suits him.
Yeah. Okay, that's brilliant. I mean, I guess what I'd like to do now is just sort of obviously we're all geared up for Wednesday. That's cool. Probably see a revision on the dots. You probably want to get long euro dollar. I've got the euro dollar chart up here. 115 is the key level for me. I'm not going to be holding on when it gets near there. I can tell you that much. In fact, I might be selling up there as well. So let's just hope it does get there. I'm sure it will on a dot lower revision.
Yeah.
The presser will be interesting because I think he'll get pressed on the money markets pricing of 2019. I think that's a key thing. I don't know if this Eurodollar futures chart will be bandied around for 2020. I know it's quite far out, but I think the rate path, his neutral. That I think there will also be questions on an update of his neutral comment.
Yeah.
The markets, like certainly last week, some plaudits were just asking, is it a dovish pivot? Is it just him stating facts, which we both know is kind of that's it, and for those of you who just kind of caught this just recently, Jay Powell a few months ago described the rate path as being way below neutral, and neutral is between 2.5 and 3.5%. We're currently at 2.25, and he changed it from way below neutral to just below neutral. And it's basically stating a fact. I just think cool heads, and Jay Powell's quite pragmatic, with also the new element of live meetings, means that we're both in agreement in that this holding hand stuff was there for post GFC. And this whole dots and this forward guidance, all this stuff. Let's get, let's just if we have some brilliant data, let's just start rate hikes. And if we don't, then just back off of it. And
to be honest, I guess it will not disappear totally, because I think the central bank starts, and JP is one of them who kind of likes to communicate, but he likes to communicate as in explaining rather than telling us where it's going. So they might keep a small element of forward guidance, but the one where the extreme forward guidance, hopefully is over by now. Let the market figure it out on the back of data. And that's what he's telling us he's doing. And so that's fine, right? Can't be too difficult to figure out what certain data means, right?
Yeah, exactly. I mean, coming to that, it's a good point actually. Coming to that, the US data still is largely pristine. You've got GDP pretty okay, year around 3%. You've got ISMs hovering around 60. You've got unemployment way below narrow. Wages not bad, pretty firm. So nothing surprising on the city surprise index. Nothing lifting, going smoking gun, all guns are blazing. I see because of financial conditions starting to tighten with the various moving parts, which include Fed funds, which include a broadly stronger dollar, which it kind of is. It's around 97 or whatever on the dollar index. Credit spreads widening, housing a problem, FANGs falling off a cliff. I'm looking at Google now. That's looking pretty precarious. And risk on rallies still getting sold into.
The price action last week was horrible on equities. So you had China actually telling us they're gonna reverse the car tariffs for US imports, right? From 40 back to 15%. I mean, I think the Dow was down 450, it rallied 100 points, and it just got smashed again. So even the stories that, let's say, a few weeks ago would have created a bit of excitement is now straight sold into. And so the price action on equities is just horrific. Really is. Really bad price action.
So that comes us to our old friend dollar yen. So that and you kindly taught me this about crosses and stuff like that. And I'm very thankful for that. dollar yen's such an important component for a lot of the risk pairs, and I just feel because we're stuck in a range, you know, for whatever reason, and you know, sometimes we all we're both cynical, right? And that's kept me alive for many years, and yourself too. At some point, dollar yen's going to be acting normally, and at the moment, it's not, right?
No.
So that affects a lot of risk.
To be honest, next week, if we get what we just discussed, so if you get a dovish hike and dots are moved lower, dollar yen is probably the first dollar I sell, even before I buy euro dollar. And dollar yen are gonna keep, because no matter where, I cannot tell you whether we've seen the top or if you go 114 first because of year-end demand in dollars or all this dollar shortage stuff that gets talked about. We can't tell you where the high is going to be. The only thing I feel strongly about is that dollar yen is going to go back down to 108, 105 in Q1 of 2019. You know, so I really strongly feel that this whole yen axis is going to roll over eventually.
The only thing I'll just quickly interject there, mate. The only thing I would say is if it's as dovish as that, would it not lift it a little bit sometimes and then come off?
No, you're gonna
with
get
an equity kind of led kind of year.
You might get a rally in the cross yen, so dollar yen might not go down or not down a lot. Now my view is more, I think dollar yen. Let's say you see the cracks in the cross yen.
Yeah.
We see the cracks for many months actually. They just haven't fully rolled over. But the one thing, and again, I don't know what kept dollar yen here all this time. When you get the cracks in the cross yen and the story starting to line up, where the equities really continue lower, the Fed is less hawkish, the yen cannot continue to have euro dollar moving for euro yen, Aussie dollar moving for Aussie yen, dollar CAD moving for Canada yen. You can have that for some time, as we've seen.
Yeah.
That is not how the yen at the end will move. Dollar yen will move. And I think dollar yen, and let's not forget, you know, the Japanese, as much as they keep talking about not normalizing policy, they have started to do micro changes on the bond buying side. On this, you know, there's soon nothing more the BOJ can buy because they already own everything. I mean, it's as simple as that. They own equities, big portion of equities, probably from every Japanese company. We don't have to talk about the bond market. They are, you know, you can close all the Japanese banks because there's only one guy who can quote JGBs now, that's the BOJ. So, you know, there is a limit to what the BOJ can do going forward. So to me, I think the chance for the BOJ to continue to keep the yen weak is gonna fizzle out. But you know what? I was just about to say, if euro dollar becomes too complicated to buy, to sell dollars because of Brexit, dollar yen for me is not a bad victim. You know, can we buy Aussie? That depends on the day. You know, if we can't really say until we sort of get into Wednesday, where we see what have equities done Monday, Tuesday, is risk holding in or not. And most importantly, and that is going to be the big one for Thursday, the day after the FOMC. If you get a dovish hike and then move of dot plots, and the Dow can't finish 500 plus, then the real selling is coming. Because then even those who, you know, up to this point believe that the Santa rally might still be happening, will give up. So we not only have to watch a dollar, I think the price action in equities could actually really, you know, the reaction to a Fed that hints for not as many hikes next year. If equities can't benefit from that,
Yeah.
then we're really in trouble. So I think there's a lot of stuff we have to watch next to trying to trade the dollar. We have to watch equities. I think it could be a real giveaway on what to expect in the weeks to come from equities.
Well, that's interesting you said about the Santa rally. Well, it's more like a Santa Grinch at the moment.
Yes, it is. Yes, it is.
So I've got dollar yen chart on the daily. This is interesting because this is the 100-day moving average. I like moving average. So here, sort of failed break to the downside. Here again. I know there's a trend line there. Here, 1, 2. This is on the daily. If that breaks, which let's face it very well could break, there's going to be a lot of people in a lot of pain. I think that could very well move right down here, which is the 200-day, which is 110.64. For starters, and then as you say, it's a bit.
Yeah, to be honest, 105, 108 is more a medium-term view for the next 6 months plus, right? Yeah. But I see 110.
December we can see that.
Yeah, 110 and change is probably where dollar yen should be since the last 2 weeks. I feel.
Yeah, I mean it shouldn't be up there. No. That's fantastic. That's fantastic. Well, that's pretty much it today. Unless there's something you want to talk about, Beat.
There's just one thing I want to just put people on the radar. For those who I speak with directly already know that I have put French bonds on my screens for the last 2 weeks, and they're going to stay there. I still keep this Bund BTP up, just not to lose sight of it, but
yeah,
I truly believe that we have to watch France in 2019. It's going to be on my radar for 2019 for various reasons. I think what's happening, even though the numbers this weekend of demonstrators were less, but let's not forget it's a week to Christmas, right? So people might have sort of taken a break, but we have to watch it early 2019. If people watch the news, you saw the same pictures in Brussels. Demonstrators attacked the European Commission today. So it's big fighting going on there, which is kind of all the similar. So the risk, and this is a risk I was worried in 2008, which never happened, luckily, but I have never forgotten it. Europe, in my opinion, with 10 years of austerity, I think we are at the borderline of this could turn nasty. So if these demonstrations continue in France in 2019, they could actually gather momentum across Europe. So this could be, and I'm not saying it's gonna be, I'm just saying it's one of the big 2019 stories I have in my drawer, which is real social discontent across Europe. And, with all the problems around, and you know what, I read in the Weltwoche, which is one of the big German solid, it's like a FT or one of the big magazines here, or The Economist, which there are people inside Germany starting to realize that Europe is cracking. The cracks in Europe are actually for everyone to see. I'm not saying Europe collapses in 2019, but I think Europe could have a very serious test again in 2019. And it's coming from France, and I'm not sure which countries, we already have a funny government in Italy, and as a result of the same structure, the same problem. So, as I said, French bonds, I think 10 years around 70 basis points, so 0.7%. 95.105 is the area that we reached on the French election when we were worried that Le Pen was going to win. So between 70 and 1, not much is going to happen. The moment we start to cross 1 is when it might become a story for the euro. It's a bit of long-term music. Can start in January, can start in March, can start in June, I don't know. But it's my first 2019 story is that one.
That's fantastic. I completely agree. The only counter I will have to that is it's France, and I say that with I have to be watch my words now. I think French people are not afraid of demonstrating, and
Right,
they've been doing
right.
it as a a socialist kind of akin to that. Some odd facts that my friend Dan told me a few years ago is, I don't know if it still goes on now, but you can insist on a 30-hour week.
Yeah,
Tube drivers get paid 75,000 euros a year. And if that changes, then there's an uproar. So that's all I can say. But I think what's happening with the yellow vest could be the accelerant
yeah.
to spread
To be
into another
honest, I
country.
think every country has its discontent of people. Let's
Yeah,
be honest. Before I know it's dragging on, but let's just spend 2 more minutes. The problem we have, which is European-wide and probably worldwide to some extent, even in the US, the middle class has disappeared, or,
yeah,
or, or in many places, the sort of middle class has been pushed to the lower end. So the discontent, it may be different reasons why people gonna take to the streets. Yes, I get the French are always the first and they go quickly and so on and so forth. But if it stays on, you will find people elsewhere in Europe going, oh yes, I really, I work hard, and end of the month I have hardly money left to buy food. And that
yeah,
is a problem, not just in France. And
yeah,
I'm not. It's let's just say for us as traders or macro traders, we try to pick 3, 4, 5 things that we look at. Just I have it on the monitor, like I had BTPs on the monitor,
yeah,
and it erupted, and now I still have it on the monitor just to see if it really calms down or not. So I like to be early.
yeah,
I pick my stories, I monitor them. I don't pull, I'm not selling euros or what. I do nothing with it other
yeah,
than just monitor. But the advantage of that is when the strains are coming, you already have the story ready.
yeah. It's not a surprise. Yeah,
And that's our
brilliant.
job, right?
Yeah.
That's all.
Fantastic. That is brilliant. All your wisdom. We are going to be around in the week on LinkedIn. It's going to be, it's close to Christmas, so it's going to be very thin. So just watch that risk. Just don't be making any massive sort of lumping in any big size. That's just my experience. But thank you very much, Beat. Before we go, I want to tell you about Beat's amazing commentary. It's absolutely, it's helped me out so many times, and he does it from years and years of experience, sat on some very big seats. But Beat, I'm not doing you enough justice. I'll let you tell our viewers a little bit more.
Yeah, thank you, Patrick. Yeah, what I do is I write the sort of do the charts in the morning, most majors pairs, quick sort of flavor of the day, the odd sort of trading ID, just give you a flavor of what I'm watching in the market, whether it's on the day or sort of more medium term. I comment usually during the day on news that I consider important and tell you what it means to me. And it's kind of information / tutorial. So for those that know the stuff, it's information. For those that are newer to trading, it's a learning as well to kind of understand what the professional trader is looking at, evaluating, and what he's doing with it. So if anyone has any interest, speak to Patrick or directly myself. Thanks a lot, Patrick.
Thanks very much, Beat, and a great session. And we'll stay in touch in the week. If you have any questions, just give us a shout. Thanks very much.
You have a lovely evening. Take care.
Take care, mate. Cheers. Bye.
Patrick. Ciao, ciao.
Cheers.